Hello, everybody. Great to be with you today. Dave Bassanese here, the Chief Economist at Betashares. A bit of a special treat for you today. I'll be just running the webinar, but we have a colleague of ours from Nasdaq. We do a lot of business with Nasdaq. Obviously, we have the Nasdaq ETF and a few other Nasdaq related exchange traded funds on the market. So we do work closely with the group, the Nasdaq company over in the US. And today we've got Phil Mackintosh, the Chief Economist at Nasdaq, who's going to give us a US perspective, a perspective on the US from the US. He is actually Australian, as you'll hear in a minute. He's got a funny accent. He's got partly Australian, partly American. He's lived in America for 20 years. But he does hail from America. Actually, what state in Australia from?
I grew up in Sydney.
Sydney-based guy. So anyway, so Phil will be going through some stuff with you, and then I'll obviously go through the Australian and markets-related stuff, and leave some time for questions. Just on that, is that slide ticked over? Nope. How do I get that to go over? I press the button. Bear with us 1 second. Hang on. I'll go and click in there. Why is that? Oh, do I do this? Here, maybe? Okay. There we go. Sorry about that. Look, the usual disclaimer, this is general information, certainly not taking into account your personal circumstances. So in no way, please construe what you're about to hear as personal advice. Just general economic and market information in terms of what's going on. A little bit of an update on Betashares. Things are always changing here. The incredibly strong growth in the ETF industry. We're so happy to, be playing a leading role in that industry. And you can see at the moment we have 42 billion funds under management. Over 1 million Australian investors now invested across our suite of 100-ish ETFs. In fact, it says 90 plus there. I think it is just ticking over the 100 mark now in terms of ETFs. So certainly lots of choice in terms of ETFs. You can make it as simple as you want, a handful of key ETFs, or as complicated as you want with lots of niche areas to invest in, but certainly a wide range of choice available. And I'll be touching on some of those later, some investment ideas I should point out. This webinar will be recorded, and everybody attending and who's signed up for the webinar will be sent a copy of the recording to review in your leisure. Also, last but not least, there is you should see a question mark on your screen. If you want to submit a question, just click on that question mark, type in your question, hit submit, and we'll be able to see it up on our screen. Often we get lots of questions. We usually don't have time to answer every question, but we'll try our best. And any other questions, we'll try to group them up and maybe send out an email with some of the answers. But we'll try our best. Many questions are covering the same sort of theme, so we might end up grouping them. So with that, I'm going to hand over to Phil. So just a little bit of a background on Phil. As I mentioned, he's Chief Economist, Senior Vice President at the Nasdaq company in the US, the group that do run and maintain the indices. Obviously, the most famous being the Nasdaq 100 ETF, which we track using our NDQ ETF. As I said, he's been in the US for 20 years. He does hail from Australia. He's had senior trading and research roles at various financial groups, including Credit Suisse, Country Investment Management. Started his career at KPMG and trained as a chartered accountant. So he's made the switch over into macro research and trading. But, a wealth of knowledge, and very interesting to hear today his views on the US and the US markets, given his prime position at the heart of global financial markets there in New York City, Times Square, New York City, I understand.
Crossroads of the world.
There we go. So over to you, Phil.
All right. Thank you very much. Let's see if there we go.
Perfect.
So I kind of figure the right way to start this is to talk about whether the US economy is still running hot. And I think the first answer is, in reality, we're probably not too hot and not too cold. And hopefully the charts and the data that we're going to talk about show you that. So we're pretty close to Goldilocks. if you look at the data in this chart, you can see that all of the advanced economies in the world, which are the blue colors, are avoiding recession, but only just. And most of the countries are growing pretty slowly. The US is a little bit exceptional, and that's why we say, is it running hot? But a lot of the countries around the world, including China, which is over towards the left there, are slowing down. And there's a lot of reasons why a lot of the countries are slowing down. But let's talk a little bit about the Goldilocksness of really the global economies to a large degree, but especially the US. And let's start with one of the things the Fed says they focus on, which is inflation. So obviously, most countries in the world had a lot of inflation after COVID, supply chain bottlenecks, the Ukraine war increasing the prices of oil and gas. And you can see the inflation spike there across all the different countries. But where we are now, almost all those countries, inflation has come pretty close to where the target is of 2%. So inflation is pretty much under control. If you look at employment in the US, so this is looking at the unemployment rate for decades, really. And although the unemployment rate in the US has started to increase, it's still at pretty close to historic multi-decade lows. So all the way back to the 50s, this would be considered pretty close to full employment, but softening. And so in that sense, we're not too hot, but we're also not too cold, which means where should rates be? And you're probably aware that most countries in the world are or have increased rates to try and tackle inflation, but are now in the process of reducing rates. And this chart shows that too. But what we're starting to see is the US rates are relatively elevated still compared to a lot of countries. Where should rates fall to? The bond market a little while ago was saying about 3%. It's actually started to increase recently, especially after the US election. But I'm going to show you some data that said if inflation's at 2%, maybe target rates really should be at 3%. And that would mean still quite a lot of rate cuts ahead. And realistically, probably the rate cuts should come sooner rather than later. So it would be nice. And I know a lot of small companies would love to see 200 basis points of rate cuts or 2% of rate cuts within the next 12 months. So let's start with the question, why is the US economy stronger than all of the others, well, at least except for Spain? And we kind of need a little bit of history, I think, to start this conversation. So looking at this chart, the red line is the manufacturing sector in the US. And you can see as we bounce back from COVID in the US, remember the US paid $1 trillion in stimulus checks. They gave a lot of unemployed benefits that were actually stronger than the wages they were earning when they were employed. So there was a huge amount of spending, but because everyone was locked down, they spent on goods, not services. Then you have the period where COVID vaccines came out and the population pivoted from buying things to basically buying services, a bit of revenge travel, going back out to restaurants. And so what happened for companies was both the manufacturing and the services sector was very strong, big recoveries. And the people that had been hired back into the manufacturing sector, basically a lot of them were taken out of the services sector pool. And so the services sector then had to try and compete for labor and hire people back out of the manufacturing sector into the services sector. So we had a real shortage of labor in that period in between. And if we look at sort of how that's affected inflation in a minute, you'll see that the supply and demand of labor really affected wages. Before we go too far forward, though, where we are right now, if you look at the end of this chart, manufacturing in the US has been in slowdown for over a year now. That hasn't slowed down the US economy because the services sector is still above that black line. It's still growing. And the services sector in the US is about 80% of the economy. So the services sector alone is responsible for the US economy still being pretty strong. If we talk about the inflation story too, just to make sure everyone's got the same background, this chart here, the orange line is the headline inflation rate. And the color bars just show where that inflation came from. So you can see as inflation started to increase in sort of April 2021, a lot of it was the supply chain shortages, that gray zone. So we didn't have enough things to buy, but we had a lot of people with money to buy them. So prices went up. And then the Ukraine conflict happened. And so oil and gas supply around the world changed, was in shortage. So those prices went up. And a lot of those problems filtered through into food prices as well, which is the green color. So you can kind of see that transitory inflation effect that the Fed was hoping would be shorter than it turned out to be, actually did turn out to be kind of transitory. Right now, if we go to the right-hand side of this chart, the black color, which is energy, has become deflationary. The gray color, which is goods, has become deflationary. And the food inflation, which is green, it's basically gone back down to pretty close to zero and back to normal. The sticky inflation the Fed's talking about is housing and core services. And we've talked about how hot services has been. But inflation is still trending down. If we look at what's really driving the GDP, though, it's the consumer. So this chart here plots the US consumer with the blue line, and you can see the effect of the stimulus checks got US consumer spending back to that pre-COVID level, and this accounts for inflation already really quite quickly. And since then, the consumer's done nothing but increase their spending. So companies have seen net increase in products sold, units sold in America, which in contrast to that Eurozone and UK colors, the yellow and the green there, they got back to pre-COVID levels after a year or so, but they haven't really seen the growth in consumer spending. So this really explains why the US economy is going stronger than the European economy and even the Canadian economy. Why is the US consumer so much stronger than we expected? I mean, one of the things that the Fed hoped when they raised interest rates was that they would raise mortgage rates and people would spend more money on mortgage interest and less money on things. Half of that happened. So the black line in this chart is showing the mortgage rates, which did triple, but the blue line is showing the actual mortgage rate being paid by people. And it turns out Americans had a long memory. They remembered the financial crisis when a lot of them lost their houses because they had variable rate mortgages or fixed rate resets. And now we have 20 and 30-year mortgages locked in, and no one's moving house because they can't afford to change from their low rate mortgage, which is below 4%, to a new mortgage, which will be above 6%.
Sorry, Phil, just so that 30-year mortgage rate, that's what's available on new loans today,
correct,
right? And whereas the other one is the average on all loans already out there.
Correct. Yeah. And so, I mean, obviously, you could halve your house size, but you'd end up paying more in mortgage interest because the mortgage rates are so much higher. So what people have done is just not move.
Yeah.
Which also means they've got that extra cash in their pocket that the monetary policy thought wouldn't be there.
Yep.
The other thing that's happened is we talked about the labor shortages. And you can see in this chart, the purple color, the Great Resignation, we called it, where people were literally being paid more to cross the road and join another company because they were so short on labor. So job switchers, which is purple, saw a much stronger increase in wages than everybody else, but everybody saw a strong increase in wages just because the economy recovered so quickly. So more money in your pocket, net increase in wages, plus you didn't actually have the impact from monetary policy. Where that's left the economy, even this year, we're still seeing net job creation. So it's starting to become a bit more concentrated in the healthcare sector, the hospitality sector. So you think hospitals, you think airlines, you think hotels. Also in construction, a lot of that's because of spending on chip fab plants and the transition to green energy that Biden's policies have introduced. But even manufacturing, which we talked about being in sort of a recession for a year and a half, have not wanted to let people go because they're worried that if they see a turnaround, there's still not enough labor out there for them to be able to rehire easily and cheaply. And so what that's meant is even though the unemployment rate is going up, the layoff rate is not. So this is looking at layoffs back 20 plus years, and we're pretty close to historically low levels of layoffs, which if you think about the impact of unemployment increasing on consumer spending, if you see somebody lose their job, the person that lost their job is going to have to stop spending. You might start worrying about your own job, and so you slow down your spending as well. What's actually happening isn't layoffs, it's people are coming back into the workforce. So people are actually seeing those higher wages and saying, actually, I might come back to work too. And so that's what's increasing the unemployment rate in the US, which is a relatively healthy increase in the unemployment rate for the first time possibly ever, but definitely in the last few decades. So let's talk about what's happening to the stock markets. And I guess the good news for anyone that's invested in stocks is most countries around the world have seen positive returns on stocks this year. This chart's looking at Asia Pac with the red line, Europe with the black line. But I want to focus on the green line, which is US small caps, and the orange line, which is US large caps. And you can see the small caps are actually not really quite back to all-time highs. They're close, whereas the S&P 500 is pretty, it's increased. It's definitely had much stronger returns this year, up about 20%, and it's pretty close to all-time highs now. The Nasdaq 100 has done even better. And so let's talk about what's going on and what's driving those particular dynamics in the US market. And if we redraw the indexes but look at them by earnings, you kind of see the same pattern here, right? So the US small cap, that green line, small cap companies have seen margin pressure. I'll show you why in a minute, but they have not back to all-time peak earnings, which explains why they're not back to all-time peak prices either. You can see the S&P 500, it is pretty close to peak earnings, and they've been growing earnings, so that supports the increase in the S&P 500 and the outperformance in the S&P 500. But really, a lot of the story this year has been the performance of the Nasdaq 100, the outperformance of the Nasdaq 100, and we can talk about why that's happened. But let's start with the bad news. Why is small cap lagging? And the real answer comes all the way back to interest rates, which we talked about at the start. So interest rates are relatively high. One place in the US that has had to pay higher interest is small cap companies. You can see that in this chart here. So what we're looking at is interest expense as a percentage of earnings before interest and tax. And you can see small cap, if we ignore the big spikes, which are when earnings fell because of recessions, we're actually in the small cap space seeing record decrease in margins just because of the need to pay interest expense by those small cap companies. If you compare that to mid cap companies, they've seen elevated interest expense, but not record levels. And then you look at large cap, that almost looks like the US households with their mortgages. They've hardly seen interest expense go up at all. So why is it so different? And this chart here basically explains it. So when you look at the left-hand side of this chart, large cap, which is orange, really have very little floating rate debt, which has been a great thing with interest rates going up. In contrast, small companies can't always fix their debt, so they have a lot of floating rate debt, and that's obviously those interest rates have gone up from 0 on the Fed side to 5, 5.5 on the corporate side, whatever your credit spread is over the top of that. So you've seen about a 500 basis point increase in the interest rate. Then if we look at the right-hand side of this chart, we're seeing the fixed rate debt that a lot of the companies have. And importantly, if we look at the middle section, in 2026 to 2029, we have 60+% of the small cap debt refinancing, not so much of the large cap debt. So small cap companies are not only paying more interest now, but if we can't get rates down in a year, they're going to be refinancing a lot of that at much higher rates as well. So small cap companies really do want to see rates come down. Like I was saying, 200 basis points in a year would be great for them. So let's talk about the US mega cap, because it really is a mega cap story. But we'll start with the S&P 500. And if we split the S&P 500 into sectors, what this chart is showing, the green bars is earnings growth. And so you can see every sector except for energy has been growing earnings over the last 12 months. The performance of the sectors is the orange dot. And so the difference between the earnings growth and the actual price performance growth is multiple expansion. You get multiple expansion when rates are coming down. You think about discounted cash flow valuations. If it's going to be cheaper to pay off your mortgage, you're basically going to have more profit at the end for a company. So it makes sense that we're seeing multiple expansion. But the point here is we've seen pretty broad-based recoveries in earnings for those large cap companies, but you'll notice that information technology and communication services have the strongest revenue growth. And if we think about that in a different way, it's actually 7 companies, those MAG 7 companies that you might have heard of, that especially earlier this year were responsible for almost all the S&P 500 earnings growth. We've started to see a broadening of the earnings growth across the other 493 companies, but really a lot of the earnings growth, a lot of the performance of the S&P 500 is coming from that MAG 7. And it just so happens that those MAG 7, if we look at them, are all Nasdaq listed companies. So that's helping to explain why the Nasdaq 100, these are 7 of the Nasdaq 100 companies. They've got heavier weights in the Nasdaq 100 because of that. They're all, if you look at them, they've all been $1 trillion market caps in the last 2.5 years, but they're also all exposed to the artificial intelligence trade that's going on. So they're growing real revenues because NVIDIA is making GPU chips, and Apple and Microsoft and Google and Amazon are buying them. There's a lot of cloud compute that's needed to factor the LLM models. And I guess if you look at Meta and Tesla and even Apple to a degree, they have the kinds of products that are probably going to be the first place a lot of us as consumers start to touch AI. So all of these companies are heavily exposed to the artificial intelligence revenue gains and spending that's in the marketplace. What's interesting is I found an index that's doing even better than the Nasdaq 100, and it's actually it's another Nasdaq index. It's the Philly Semiconductor Index, or the SOX. And you might think it's maybe a more concentrated version of those MAG 7 stocks. It's actually not. It's got NVIDIA in it, but it's got a bunch of other stocks that are heavily involved in technology spending, in chip design, chip manufacturing, Semiconductors, as it says in the name, is the index. So you can start to see it's not just the Mag 7 that are benefiting from this artificial investment spending as revenues. There's a lot of other companies that are building chips out as well. So I figure there might be some people interested in the US election, considering I just came from the US, and I guess I got to see it firsthand. Obviously, early days yet, but if we sort of think a little bit about what the US election means, Trump wins the election. A lot of his promises, if you look at the orange bars in this chart, were cutting taxes. So cutting individual taxes, cutting business taxes, lowering the corporate tax rate. That's all going to increase the deficit. But what Trump was proposing in terms of reducing the deficit is switching to a tariff-based structure of revenue collection. And so it's unknown how much the tariffs will be at this stage. It's unknown how much people will modify their supply chains to try and avoid tariffs. But some of that increase in the deficit will be offset by tariffs and tariff revenues. What's interesting is Trump has already obviously been president. And so Trump 1.0 did tariffs on China. And you can see the impact here, even after Trump left office. The amount that China exports to America has shrunk. It's down 40+%, mostly because of those tariffs. So other countries have benefited. You can see some of the, I guess you call it nearshoring with Taiwan, Korea, and Vietnam. So locally close to China countries benefiting because they're exporting to the US more now. Some friendshoring with the Euro area benefiting, Mexico benefiting, even Canada. So what you're going to see with tariffs is more of this. So the countries that have higher tariffs, it's going to be harder to import goods from them. So that's going to slow their economies down because America has a big deficit. So we're importing more than we export. But basically, we're going to see some pretty big supply chain impacts if the tariffs go through as expected. And so this is actually, it's not my forecast. Oxford Economics did a really interesting forecast about what would happen with a limited Trump presidency where he just becomes president, or a full-blown where we have a sweep of Congress. So we have the House, the Senate, and Trump all being Republican, and we're pretty close to that. We still don't know the House yet, but it's looking like it might actually be full-blown. In that case, we add the gold color here to the red color, and the GDP impacts. If you increase tariffs, you're going to make it harder to do trade. If you do reduce trade, obviously you're going to potentially reduce GDP in a lot of countries because they're going to export less to America. And what this did was it looked by region where the impacts were greatest. Sitting here in Australia, we probably shouldn't panic too much about Asia Pacific being as impacted as it is, because I think a lot of that's China, a lot of that's those countries that are near China, rather than down here in sort of the Pacific region. But the US itself is probably going to have a pretty big impact from tariffs as well, just because the supply chains that companies have. And I know I talk to companies because they list on Nasdaq, and a lot of them are going to have to think about whether they move factories, try to rehire in new countries just to pay less tariffs in their supply chain.
Fantastic. Thank you. And Phil's very good economist doing webinars because he's right on time here. We're not over budget on the time front. So I will now take over and talk a little bit about the Australian economy and markets, a little bit about Trump as well. You can never go far these days without hearing about Trump, unfortunately. We'll be hearing a lot more about him in the next few years. So let me go. I'm going to touch on the key developments in the Australian economy first, and then just a rerun of my kind of views on financial markets, and then some investment ideas. First and foremost, I mean, obviously, as Phil mentioned, the most critical issue at the moment is getting inflation back down to pre-pandemic levels. This is where we are at the moment. So the September quarter CPI that came out a couple of weeks ago is in the orange, is the quarterly numbers. The dots are the monthly CPI, and you can see we got the headline numbers come down. It is actually in the RBA's target band now of 2.8%. The monthly number, so the month of September, the year-on-year measure, has actually dropped to 2.1. It didn't get as much media attention as that quarterly number. That was a pretty substantial drop. Now, of course, electricity, cost of living measures are a big part of that. That's why the RBA is focused on underlying inflation, the trim mean measure. And there we can see, look, the story of the first half of the year where inflation stopped falling and was going sideways. In fact, on a monthly number, it was going up. The good news is that over the last quarter and last few months, based on the monthly, is that it has resumed its downtrend. So the annual rate went from 3.9% in Q2 to 3.5% in Q3. The RBA's forecast is for that measure to be 3.5 at the December quarter number, which we get in late January. So I would characterise that the CPI that we got was okay, good, not great. We didn't get a major downside surprise, so we needed to get a major downside surprise, something like quarterly trim mean inflation at 3.25, if not lower in Q3 to see any chance of the RBA cutting rates at the November or December policy meetings. We didn't get that. We now know, of course, the RBA didn't cut rates in November, but it's, I think the case for a pre-Christmas rate cut at the December meeting really out the window given these numbers. Look, just as Phil mentioned, interestingly, the key sticking points in Australia in terms of inflation are housing and services, core services. So rent increases, housing repair costs, housing construction costs. Still, if you look at where inflation is amongst many components of the CPI today compared to what it was averaging prior to COVID, one of the big ones is still housing. And the other one is core services, and in particular things like insurance prices, but even like restaurants, a whole myriad of services that have a lot of labour costs involved. They are still above their pre-pandemic levels. So that's where the sticking points are. But with the economy slowing, unemployment gradually drifting up, wages growth is coming down. We are certainly hopeful on the services front that things will ease. The rate of increase in immigration, the influx of foreign students post-COVID is also easing. So that suggests that rents will also start to ease. So I'm still very hopeful that inflation is going to continue to come down. In fact, my base case, I'm jumping ahead, but I still think the RBA, my base case is still the RBA can cut rates in February. But it will depend on that quarterly, on that Q4 number that we get in late January. And I'm counting on the trim mean to go from 3.5 to actually 3.25 in December. That you need a quarterly increase of about 0.6, 0.7. It's been 0.8 for the last few quarters, so I'm anticipating a drop down. But if we get 3.25, I think that'll be good enough for the RBA to at least, cut rates in February. Maybe not then immediately cut rates in subsequent meetings, but at least do one, maybe then sit back. But we'll see. Maybe at the moment, the markets are not really pricing that. They think that the RBA is not going to be raising rates till the second half of next year. Part of the reason that being the concerns about inflation globally, with Donald Trump coming back into the presidency and the tax cuts and the stimulus that he might offer. But that is the inflation story in Australia. In terms of the labour market, the other thing happening, look, the economy is not supercharging. It's not growing strongly. It's still subdued growth, particularly in consumer spending. Again, unlike in the US, where consumer spending is still pretty solid, in Australia, it's very subdued. But the labour market is still pretty solid. So the unemployment rate, as you can see there, it's gradually lifted through the course of this year. It did hit 4.2. It's now ticked down to 4.1. You can see population growth. So working age population growth, thanks to that rebound in immigration, is running at something like 50,000 a month. So we need 50,000 new jobs every month just to employ, the growth in the population. So that's why we're seeing continued strong employment numbers. Every month we get a payrolls result and it comes out and it shows that, employment's up 30, 50,000, but in the unemployment rate, isn't going down because it's reflecting that solid population growth we're still getting. And also you can see the participation rate, again, a bit like in the US, we're at record highs. Now, there's a lot of reasons for that. Older workers are staying longer in the workforce. You've got the ongoing growth in female participation. And you've got, maybe an element, given the cost of living squeeze, that, many people are having to work longer, or, people that would otherwise stay at home, maybe looking after the kids on home duties are being dragged into the labour force to, help pay for the mortgage and things like this. So there's some positives and negatives behind that participation rate. But that is, so just in summary, the labour inflation is coming down. It's still not where the RBA would like it to be. And the overall economy, yes, consumer spending is soft, but the labour market is still pretty solid, and there are areas of strength in the real economy. So the real economy is strong enough for the RBA not to be worrying about recession anytime soon. That'd be the only reason it would cut rates absent a decent decline in inflation. But overall, the activity numbers are still solid enough to keep the RBA, sidelined at the moment. Just on house prices, I mean, what we are starting to see is a moderation in house prices. If you look carefully there, you can see the grey line is Melbourne. And so house prices really have been going sideways in Melbourne, despite, strong rebound in immigration. So the Melbourne economy itself is going through a bit of it's pretty sluggish at the moment. You can see Sydney prices are starting to roll over. In October, we got the first negative decline, 0.1%. It was very small, but nonetheless, that strong rate of increase in house prices that we saw from late 22 through 23 and the first part of 24 is starting to roll over. The cheaper cities, things like areas like Adelaide, Perth, and to an extent Brisbane, are still super strong. So we're seeing the more expensive cities tapering off, and I think that's a lead indicator that we will start to see tapering off elsewhere. Why is this happening? Affordability. Basically, house prices have risen to such an extent that the average home owner, given prevailing incomes, prevailing interest rates, really can't afford to pay a lot more for a house. And so we do reach affordability limits, and I think that's what we're reaching at the moment. So my view is that house prices are going to start. We will start to see gathering softness until such time as the RBA can start to deliver rate cuts and restore some degree of affordability on that front. Just on Donald Trump, a couple of points I'd make. I think this is an interesting chart. I mean, I think everybody was pretty gobsmacked by not that he won, but just how comfortable the victory was, and the increase in support that he got from many areas. So this is more of a political comment, but I just think it's interesting. So I've just taken some surveys. There's a group called AP Votecast who actually survey people, how they voted and what their age is, their education, their ethnic background, and that sort of stuff. And you can see, Trump managed to, compared to 2020. He's increased his vote, across the board. If you look at like women, a lot of debate about women's issues during the election. Kamala Harris hoped that she would get a lot of moderate Republicans switching sides and voting for her. But the women vote for Donald Trump actually went up. And it wasn't just in non-college educated women, even college educated women. It's a smaller increase, but you definitely didn't get a massive swing toward Harris in the election. So, what Donald Trump has managed to do is increase his vote amongst the non-white, as it's called in the US, like the Latino and the African American groups, particularly younger males, but doing so in a way that hasn't really didn't bleed a lot of votes amongst women voters. So end of the day, he focused on economics. He focused on economic issues, the cost of living pressures. He focused on immigration, and these are things that these groups really cared about. Harris, was focusing on pretty good things nonetheless, women's issues, reproductive rights, whether or not Donald Trump was going to be a fascist or not. But these things just didn't resonate with the swing voters that she needed to attract, and that was the bottom line. So it was, a pretty impressive result. And, as Phil mentioned, not only has Trump won the presidency, there's a very good chance that the Republicans will have, or they do have, the control of the Senate and likely control or retaining control of the House of Representatives. So they can now, basically Donald Trump can do anything he wants because those guys are, men and women in the Republican Party now are beholden to him. I mean, he is almost like a king-like figure now, I think, in the US over the next few years. So that is good and bad because, for example, the Republicans have always talked about the budget deficit. They've always talked about, excess government spending. Yes, Donald Trump is going to deliver tax cuts. Now, just on that, the one new policy will be corporate tax cut, cutting the rate from 20 to 15, as I understand it. The income tax cuts for households, it's not a new tax cut. It's really just avoiding the increase in taxes that would have otherwise happened under current policy. So he's just going to extend those tax cuts out. So yes, it is a cost to the budget, but it's not really extra stimulus because these people are already enjoying that tax cut and we're just stopping them no longer enjoying that tax cut is the way to think about it. But he's got Elon Musk on board to say, he reckons he can cut $2 trillion out of government spending. The thing about it is the Republicans will have no excuse not to do the things they've said they'd always want to do, because there's no Democrats that can hold stuff up. So it's going to be interesting to see if they really do, manage to cut back the deficit through spending. Now, we can argue where and whether it's a good or bad thing in areas, but I mean, we'll see what they plan to do. One of the challenges, of course, in the US is much of that spending is mandated for insurance, Medicaid, Social Security. These are tough areas to cut. And then you've got defense spending. Outside of that, there's not a lot of areas. So it's just going to be fascinating to see if they can deliver spending cuts at the same time as delivering, tax cuts, and maybe make the budget deficit situation better. But at the moment, they're obviously talking a lot about the tax cuts. Now, I've just got a little summary. Has that gone through? Just to summarize the issues in terms of markets. So the good things are tax cut. Well, you could argue, but one policy is obviously cutting taxes, fiscal expansion, depending on how much they cut government spending. That is leads to upward pressure on bond yields, upward pressure on the US dollar. Basically, the more the government stimulates, the less the Fed needs to cut interest rates. And so we've already seen an adjustment on the bond market on that front. I've put a question mark on equities. Equities are rallying at the moment, happy with those tax cuts. Problem is, and that will happen depending on what happens in the bond market. If the bond market gets really worried about inflation, bond yields, go up over 5%. 10-year bond yields have gone from, 3.7% a couple of months ago. They hit a low of 3.7%, now back up to 4.5%. If they go back over 5%, heaven forbid 6%, we've got a real problem, and the equity market won't be able to ignore that. But at the moment, the bond market adjustment has been, moderate, because the Fed are still talking about cutting rates, so that's limiting the upward pressure on bond yields. But the equity market, I've got a question mark at the moment. It's positive, but we're watching the bond market carefully, because the biggest risk to the equity market here globally at the moment, I would say, is bond yields and what may happen in the bond market, given the likely stimulus coming from Donald Trump. Deregulation is the other one he's talked about. So that's generally positive. That's like a positive supply shock. If you can boost productivity, that would put downward pressure on bond yields and upward pressure on equities. And then the other one, of course, is the tariffs and the trade wars that Phil has mentioned. Unambiguously negative for equities if, trade wars built up. Probably positive for the US dollar because of a risk-off, not only risk-off, but if it improves the US trade situation, they cut back on imports, it puts upward pressure on the dollar. Bond yields, it depends on whether it's a risk-off or risk-on. I mean, if it leads to higher inflation in the US through tariffs, it could put upward pressure on bond yields. But if it really hurts economic growth, it could go the other way. So that's where the question mark is there. But all the other, I guess, bottom line of all of this is that this is generally positive for US equities, and US equities have been outperforming for such a long time, particularly those large cap tech companies in the Nasdaq that Phil mentioned. But what we may be starting to see under Donald Trump is a bit of a rotation from those, not necessarily them falling, but just not rallying as strongly, and maybe getting a stronger rally from the smaller caps. That may benefit more from the tax cuts and an eventual cut in interest rates from the Fed. So you may get ongoing US outperformance, but maybe a rotation in the US market from the large caps to the smaller caps. Just in terms of financial markets, so central banks still on track to cut interest rates. I mean, there has been in the US, they've scaled that back. The markets are now pricing in one more rate cut in the US this year. There is one more meeting this year. And then about 50 basis points. It's about only 50. So it's been quite a notable scaling back of rate cut expectations in the US now. So they're only pricing in 2 25-point cuts in 25 from up to 4 to 6, only a while ago. So again, it just depends on what happens with Trump and with the Fed. But the rate cuts are still coming through, but just at the moment, they're not expecting as much as they were previously expecting. And you can see in Australia, no rate cuts expected this year, but about 50 basis points of rate cuts priced in next year. Now, I actually think the markets are now getting to a point where they're too pessimistic on the rate cuts. I think the US will cut rates by more than 50, and I think the RBA will probably cut 50 at least, but possibly 100 over the second half of next year as inflation comes down. That means that bond yields, look, they did get over 5% late last year. This is US 10-year bond yields. They've backed up a little bit to 4.5%. But if you think the Fed is still going to deliver rate cuts, I think the trend for bond yields will be down. Again, the caveat being Trump and the deficit. But my view is that bond yields over the course of the coming year is still coming down. So I'm still positive on fixed rate bonds. And in fact, the backup in yields we've seen lately does represent a buying opportunity, I think, in fixed rate bonds if you haven't already had a nibble in that area. And I'll have some investment ideas in that regard later. But again, the point of this chart is to show you when you're in a rate cut cycle, bond yields generally fall. You're not going to time the peaks and the peaks and the troughs perfectly, but generally the trend is going to be down as we move into the rate cut cycle in the US. And that also means that I've got a chart here of the relative interest rate of Australia versus the US in black and the Aussie dollar in orange. And basically that's the projection, given that my expectation that the Fed will cut rates more aggressively than the Australia over the next year, that interest rate differential will go back from what is currently a negative one to a neutral. We'll have a similar cash rate. And that increase in the interest rate differential, if you look at that chart, should put upward pressure on the Aussie dollar. And I've still got it getting to 75 cents by middle of next year. Again, Trump and fiscal stimulus is a risk to that scenario. You can see the Aussie dollar is actually, it's gone from 69 cents a few weeks ago back down to 65 cents on the back of Donald Trump's victory. But again, I think the interest rate differential story is going to be the main driver there. And I'm still bullish on the Aussie, and particularly now given where it's fallen back to. Gold also, again, this is one, actually just a summary. Basically, again, if you've been part of our webinars for a while, you know we've been talking about the soft landing scenario where, inflation's come down without a recession, so central banks can cut interest rates, support economic growth. That's good for bonds. It's good for equities. It would mean a weaker US dollar. So lower bond yields, lower US dollar is good for gold, and gold has been rallying. Now, the big new variable is the Trump trades. And as I said, at the moment, the markets are jostling with the soft landing scenario versus the new fiscal expansion, potential tariff wars from Donald Trump, which could put upward pressure on bond yields, upward pressure on the US dollar, have mixed implication of equity. So we're jostling with those two factors at the moment. That's why bond yields have gone up. That's why you can see there that gold has had a bit of a correction. But if you think the soft landing scenario and the Fed will still be able to cut rates, growth will hold up, will prevail, which is still my base case, then again, I think it's still bullish for gold as well. On equities, just look, this is a regular chart. I mean, the key point I take there is that overall, global equities are trading about 18 times earnings. They're in the range that they've been in over the last few decades. US markets are more expensive at 22 times earnings. My expectation of that PE ratio expansion that we've had since late 22 will start to top out. I don't expect further gains in valuations. But if you look at the top slide, earnings growth is still positive. Markets still expecting positive growth in earnings in 25 on to over 26, and that orange line forward earnings should continue to rise. Now, again, one caveat, if you look closely at that top right chart, you can see there has been some downward downgrades to earnings expectations for 25 and 26, and actually a bit of a turn down in forward earnings just in the last couple of months. So that continues to bear watching. The overall outlook is still positive, though we won't want to see, further substantial downgrades in the earnings outlook because then that story will start to get a little bit messy as well. Because bottom line is you can't expect much return further from valuations, given where we are, but we're hopeful we can get further return from continued growth in corporate earnings. Australia still think will underperform. The earnings outlook in Australia is not as great as it is globally. And, not much to say there. We'll be dragged along a little bit by global markets. but probably continuing to underperform. And I think the US market, is still going to be although it is expensive on an outright basis, it does have the earnings growth, and it does have Donald Trump now favouring it. So again, it's a pretty sorry tale in terms of relative performance of Australia. Really since early 22, and I don't anticipate that changing anytime soon. Last but not least, in the final section that I have, investment ideas, and bottom line is where are the interesting trade ideas, investment ideas that come out of all of this. Firstly, I mentioned fixed rate bonds. So, we have a composite bond index, OZBD, gives you exposure to Australian government and corporate bonds. Gives you a better yield over time than the AusBond Composite Index, which is the standard index in Australia. We think we've come up with a better indexing methodology that mimics that index but gives you a better yield over time. And another option is CRED, which is full corporate bonds, but long duration corporate bonds, and gives you a nice yield. So if you think bond yields are coming down, if you think credit spreads will continue to contract with the economy, at least holding up and gradually recovering, then you get two bangs for your buck, if you like, through CRED. You're getting the duration benefit as bond yields fall, and you're getting the credit benefit as credit spreads continue to tighten. So fixed rate bonds, still like those. Within the US market, again, to Phil's point, what we may be seeing is a rotation within the US market to the smaller parts of the market. Not to say the Nasdaq won't continue to do okay, but maybe some of the other neglected areas of the market catches up. So one way to play that trade is through the US equal weight ETF, and we have two options there. We have QUS, which is unhedged, and then HQUS, which is a currency hedge one. So if you think the Aussie dollar is going to go up, you generally want to be hedged. So, HQS would be the way to play that, but, it's up to you whether you want to hedge or not. But that's just one way. It's still the US market, but it has lower exposure to the large cap tech companies because it's equally weighting all the companies in the S&P 500. Last but not least, in the Australian market, quality, AQLT is it's a exposure to what's called the quality factor, and these are companies with above average return on earnings, return on equity, moderate rates of debt, not too overly indebted. One way to have a high return on equity is to have very little equity and a lot of debt. So we make sure that we screen out companies that have a lot of debt to generate a high return on equity. And generally speaking, quality is a great factor. Not all the time, but generally over time, it outperforms the broader market. And certainly in Australia, it's been doing very well. These are companies, pretty strong balance sheets, good profitability. So an easy way to get access to those type of companies is through AQLT, the Australian Quality ETF. So just a few ideas out there for you. And again, just to summarize, the soft landing scenario that we've been talking about in the last few quarters are still in play, though we've got the Trump trades and the new Trump juggernaut, which is going to maybe, add a bit of volatility over the next few months, and it's going to be fascinating to see, what he ends up doing. One suspicion also is that maybe his bark is worse than his bite. He's talked about 60% tariffs on China. Maybe that's a bargaining chip. He'll go in there and try to come up with some deals. But so one thing will be how, in terms of economics, how tough he will be on trade, whether the Republicans are as serious about cutting spending as they've often said they are, and whether that can contain potential inflation bond market concerns about the tax cuts that are coming. That's it. We'll take some questions, and lots of questions as I've said, and we've got about 15 minutes or so, is it? Yeah. So good time for questions. So let me. Given the election results, what impact will this have on emerging markets is one of the questions that have come in. Do you want to take that? Do you have a view on that, or you want me?
I'm interested to see what you think, actually.
Well, I think the short answer is it won't be good for emerging markets because obviously China's 20% of the emerging market index, the MSCI emerging market index. China's 27% of that. So China's in the gun sights, if you like, of Trump in terms of trade tensions. So there's obviously a new risk factor for China. To the extent the stimulus, fiscal stimulus causes a stronger US dollar, that's generally not good news for emerging markets as well. A strong US dollar adds to their financing costs. One area that may do well is India. And again, this is a theme that we've been talking about in recent webinars, is China under pressure, but India, looking good, is maybe the new jewel in the crown in terms of emerging markets. And so II-IND is our India ETF idea in that area. IND, IIND, yep. Any thoughts?
I mean, I think the tariffs, if they really do happen, knowing how Trump is, he says 10% across the board, but I don't think that might be where we end up. He's very good at doing bilateral deals. It's kind of his shtick. So if I was at a conference last week where someone was talking about the fact that if you've got a good relationship or you're actually a net importer from America, then they might go easier on you. I know Modi's got a great relationship, so that speaks to your India idea.
Yes.
But if you're a country that's got a big surplus with America, then the tariffs will help offset that surplus. So I think to a degree, it's going to depend country by country how aggressively he wants to tariff them and what they export to America. And that could slow down their economy at totally different rates depending on what they're actually exporting.
And I should point out at this moment that Australia run a trade surplus with the US. Also, we're a major, important ally with the AUKUS still. So, we're giving the US billions of dollars for their, submarines and whatnot. So I don't think we be surprising if he, attacked us with tariffs. I think we're going to, I don't think they want to upset us too much in that regard. The bigger risk for us is the blow, the indirect effects on us if it hurts the Chinese economy in particular. And for example, if China starts trying to take more stuff from the US and less stuff from us, and there's a bit of a trade diversion that goes on. But directly, I don't anticipate Trump to start hitting us with tariffs because, again, we actually export. We import more from the US than they take for us, so we're in the good books in that sense. Is it time to consider factor investing, particularly quality investing? Well, I did touch on quality, and I think yes, it's a very again, I don't know if many people, if you're not familiar with factor investing, you might just a brief cap on that. I mean, so if you look at global equity markets, there's different ways to play it. Certainly from an ETF point of view, you can play it from a country perspective. US versus China versus India versus Australia, Europe, Japan. You can play it from a sector perspective. You can look at like financials versus resources versus technology. There are ETFs in all of these areas. Or you can look at it from a factor perspective. And factors are characteristics of companies which historically have tended to lead to these companies outperforming the market. So they're still indexes. They're a different way of indexing exposure to different markets. It's not a discretionary thing. Well, it's discretionary in the sense that people come up with the quantitative rules to choose companies, but one of which is like quality. So as I mentioned before, there are companies with generally above average return on equity. So you look at all the companies in the market, you screen them, you get the ones with the highest return on equity. They are called quality companies. You can wrap that up into an ETF, and that's what our quality ETF does for both Australia and global. There are different types of factors out there, but that's one that generally, I think has been one of the more durable sources of performance over the years. There's value as another factor. I don't have time to go into them now, but if you don't know about factor investing as a methodology, certainly Google it or look at our website. There's a lot more information on that. Australian market seems to be losing stocks to private equity. The recent Chemist Warehouse deal is a good example. What is the outlook for the Australian market given big companies keep getting removed from the market? Now, I don't think, Australia is not unique in this regard. I mean, the rise of private equity is happening, around the world. Twitter went private. Elon Musk bought it, took it off the market, now called X. End of the day, I mean, it's if the companies that are still on the market are doing well, then the market is going to continue to do well. So I think losing some to private equity is just the name of the game. Maybe it's happening a bit more than it used to happen, but I don't think overall it's going to shift the outlook for equity markets. And also you've got IPOs. Some leave and new ones come on board. So
I mean, it's interesting, right? Because I totally agree. This is happening everywhere. And the US has an especially well-funded private equity market. So I keep bumping into companies that were meant to IPO.
Yeah.
And they got a call from a private equity guy 2 days before, and it was a better valuation than they would have got in the market.
Right.
So they stay private.
Right.
But what's also interesting is the strength in the US IPO market is kind of because we have such a strong private equity market.
Yes.
The private equity guys really want to get in before the companies get mature. And sort of help them grow to scale.
Yeah.
So typically a company gets to 8 or 10 years old, and that's when it IPOs.
Yeah.
So actually having a strong private equity market can be helpful, bringing these companies, like getting them to scale and bringing them into market as stable companies with either closer to profitability or talking about factor investing or actual profitability when they hit the market too.
I guess one issue there is, of course, you're getting, to the extent private equity hold on to them for longer, when they do come to market, maybe there's less growth upside. There's a bit of an argument that private equity, get them to where they want to be and then, then sell them on into the market. So there is something just, again, I think it's maybe
just a
happening.
Reality of equity markets.
But I guess it means extra caution, when you do consider IPOs, particularly if it's something coming from private equity that have been held for a number of years, and they've got it to a perfect state. They've got a high valuation on it, and you just got to be careful you're not buying it at a time where it's already at a peak. So companies generally, with the advent of private equity, mean they're coming listing on the market at a more mature stage of their growth cycle. I think is one observation of what's happening. All right, moving right along. Let me see. Something that we haven't talked about, maybe. What would you expect? What happened? From the Australian economy, supply chain issues. What do you see in the near future of the global economy going to come? Oh, we haven't mentioned geopolitical risk. I mean, that's obviously we've got the ongoing situation in the Middle East, ongoing situation in Russia. And again, it's going to be another fascinating outcome. Donald Trump famously said he'll deal with the Ukraine situation in a day. We'll see what happens there. But that there may well be some resolution on that front quickly in the new year, given his determination to do something there. Whether that's good or bad for Ukraine, we'll see how he wants to play that. In terms of the Middle East, I mean, I think unfortunately there seems to be no end in sight in terms of that. We've conflict.
I hate to speak like an economist, but we've kind of been lucky with the Middle East that it hasn't gone into the energy producing countries yet. Because from an economics perspective, if one of those energy producing companies gets involved in the conflict, the supply of oil is going to get upset. It's going to be like Ukraine, because that was one of the problems economically with Ukraine, where Europe got all of its oil and gas from Russia, and suddenly that got turned off. So they had shortages, which meant the prices went up. If that happens in the Middle East, we could have another spike in inflation, because there's like a 70s style problem with supply of energy, oil and gas. And then we've got higher interest rates. We've got much higher inflation because of the, you could see a big disruption. I think that's like a known unknown at the moment.
Yeah, and I guess the key issue there in the Middle East is that so far, at least, as horrible as the situation is, it hasn't disrupted oil supply from Iran in particular. Every time Iran and Israel exchange missiles, there's a concern that it's going to disrupt supply. And obviously we're worried about the Strait of Hormuz, if I've said that correctly, which can affect a lot of oil coming through the Middle East. But again, as horrible as the situation is, from a market's perspective, it so far has not disrupted oil supply. So, the markets
inflation keeps coming down, rates coming down.
So that's the big risk on that front.
Yeah.
There's some other questions here. Let me see. I don't want to. Okay. Oh, hang on. Thoughts on small equity on house? Yeah. So one issue with the equity market is, at the moment, if I go back to, can I go back or not? Can't go back. Can I go back? Oh yeah. I mean, if you look at the bottom right slide there, the orange line is the equity risk premium. So that is the difference take the PE ratio of the market, you invert it, you get the earnings yield. You take away the 10-year bond yield, you get, a measure of the relative value of the equity market versus the bond market. Now, with the PE ratio having gone up, but particularly given the backup for bond yields, that equity risk premium, particularly in the US, has narrowed, quite tight. So valuations are stretched, both in an outright and a relative sense in the US. And it's, I think it's been reflective of the ongoing relative strength of the US economy, ongoing relative earnings performance. But it is, it is being reflected in pretty rich valuations. But if the earnings are still there, and the global economy keeps growing, then I think equity markets will hold in value, and certainly if bond yields come down, some value can be restored to the market.
I mean, looking at the PE multiples, though, it really is that Mag 7 type problem, because if you take them out, the rest of the US market doesn't look as rich as we're talking about. And what's interesting about the Mag 7 stocks is they keep looking rich, and then they deliver on good earnings growth.
Right, yep.
So their earnings go up, which means their PE comes back down. And then they look rich, and then their earnings come in with strong growth. So you keep thinking that those Mag 7 stocks are going to get richer and richer and richer, because their prices go up and up and up, but they're actually growing earnings so fast in reality. I mean, this is not the tech bubble, because there's real earnings behind it with real earnings growth. And actually those companies have strong margins too. So they have good profit margins when they make revenue. So the PE multiples, it's definitely higher for those companies, but they keep delivering. So while they keep delivering on the earnings growth forecasts and the strong margins, it's not as rich as it looks.
That's right. So again, at the moment, as long as things keep going along as they were, and I guess our base case is that they will, and there are obviously always risks out there, but at the moment they are delivering on the earnings front, and as long as they keep delivering, then those valuations can hold up. Other questions? Can how the tariffs impact on the global. So how do I mean, again, just on tariffs, I mean, tariffs are a tax on imports. Now, Donald Trump has said that, they'll be paid by the foreign supplier. They won't, be, every economist in the world knows that that's not true. It depends on the, they'll try to pass it on.
Elasticities.
Yeah, exactly.
It's a little nerdy economic term. But basically, you pass on as much as you can as a company. So
exactly,
it could be everything. It could be half. It could be not much. But I mean, one of the interesting things when we saw the taxes in the US with Trump 1.0, the Chinese turned around and did the soybean tariffs, and basically the soybean industry that year was totally changed.
Right.
So the taxes went up, and the supply demand went down.
Right. So again, we'll see if his bark is worse than his bite. But again, I guess the other point is we've been here before. In 2016, we had the trade wars, and as I've often said, the global economy wobbled but did not topple over. We had a correction in the equity market at various points through 17 and 18. But we didn't have a global recession. The trade wars did not cause a global recession. And ultimately, Donald Trump is a businessman. I think his biggest barometer of popularity and success is the share market. So as soon as if he starts doing stuff that leads to a correction in the equity market, 5% off, even 10% off, I mean, I think that'll be a self-corrective mechanism there. He's not going to.
That's what a lot of economists are already saying.
Yeah. So, love or hate him, I don't think, people say he's crazy, all this sort of stuff. I think he's a pretty wily guy, and still, very switched on for a guy approaching 80 years old. So I don't think he's going to go crazy. Certainly go crazy in a way that will hurt the share market. How are we going for time? Got what, 5 more minutes or no more time? Okay, so we'll wrap it up there. Again, we'll see if we can maybe send out an email trying to answer some of the other questions. Great to have you along today, Phil.
Thanks for having me.
Make it a little bit different.
Great to be back in the country.
Yeah, definitely get a US perspective, albeit from an Aussie, but someone who's been there for 20 years. Again, as Phil, comes from the company, the Nasdaq, We love the Nasdaq. We've got a few Nasdaq ETFs. Nasdaq market has been good to us. It's been good to many of our investors, and we hope that continues. We anticipate it will continue. So bye for now, and we'll see you again. Oh, sorry, I was remiss. Last question. Sorry, I don't want to forget it because our lawyers will be on to me. There we go. Yeah, things to consider. Obviously, all these things have investment risk. Every ETF we've mentioned has a product disclosure statement. You can go to our website and look up that information. Future outcomes are uncertain. Desired returns, may not be achieved. And again, I stress there's no in way personal advice. It's general information only. And I think that's, all the usual caveats in terms of investment one needs to consider. So again, great to be with you again. An exciting new era under the new US president. We'll wait and see. Mixed emotions out there about his return, but it's certainly going to be an interesting, add to the interest in markets and help keep us two employed anyway.
Going to create some winners and losers, I think that's for sure.
No worries. Bye for now.